So now we will move on with a little bit of a panel discussion. And I will pose some questions to the companies. But first, let me introduce our people who are sitting here. I also do it in alphabetical order. It's the best, I would say. Eric Owens, who is the CEO of Alexandria Minerals. And as I said already, they are working in Val d'Or, in Quebec, also in Manitoba, and Snow Lake Flin Flon. I really like that name, honestly. And their flagship property is a large catalytic break property package in Val d'Or, which hosts important near-surface gold resources. And what is also really important, the company is very, very active. The drills are turning. Yeah. So we will see some good results, hopefully before Christmas also. And what I really like are two things with the company, which are really important as a takeaway. The global gold resource measured and indicated is 1.4 million ounces and 939,000 ounces of inferred. That's pretty nice. They have 4 times higher resources since the last 2-3 years they generated. And I think that's a great success. They put the money in the ground. That's also a thing which is not always usual with resource companies, especially with exploration companies. But what is the proof of concept? The proof of concept is that you have Agnico Eagle as a 10% shareholder. Agnico Eagle is working very actively with them. They have bought almost 2 years ago for $5 million one property of them, but Alexandria still retained a 2% net smelter return. So that means they can finance the company through the partner, but return the upside for the future because Agnico Eagle needs the property for their Goldex mine there. And also, they have other big partners like Teck holds 2% on the company, IAMGOLD holds 2%, and big funds and high net worth investors are in with around 50%. So pretty stable company, pretty deep pockets, because that's exactly what you need in the exploration space. And active partners who help to develop your company. Then we have First Mining Finance, Patrick Donnelly. You know quite well. And First Mining Finance, as I said 30 minutes ago, this is the development of a mineral bank. And I really like what they do. Honestly, I was not clever enough. I was sitting 2.5 years ago with you and Keith at a little bar at a hotel down there, and you explained me your model. And I was like, do I do that? Do I not? I don't know. Do I step into the private? I was an idiot. I know. I was an idiot, definitely. And I did not, I did believe in you guys, that's no question, yeah? I mean, people like Keith Neumeyer and also Patrick, they have really proved that they can do it. I was not believing in the markets. That was my only problem. And I missed a lot of money I left on the table, unfortunately, but probably, maybe there's another chance to get maybe a little bit cheaper in, and I will do that for sure. Keith Neumeyer, who is also the founder from First Majestic and was the founder of First Quantum Minerals, and they had the idea to take advantage of the beer market. And again, they have the deep pockets, they raised the money, and they bought the dollar for 10 cents. And that's exactly what you should do. Yeah? And as I sometimes say in my road shows, they did it in perfection. As you know, I'm from Stuttgart, I'm a Schwabe. And you have an idea how a Swabian guy is swimming? That's how he swims. Yeah? That's exactly what those guys were doing. And they did it in perfection, really amazing. And so they assembled over 25 projects. They have a big pipeline. They have now 6.5 million ounces of gold in the measured and indicated category and 3.5 million ounces in the inferred. So that means almost 10 million ounces from zero. That's sensational. And they work in Canada, Mexico, and the United States. And of course, very active, really pursuing their goals and their targets. And I think they've done an exceptional job so far. And also, I'm pretty sure that those markets will, in the future, will go up and not down again. It looks much better, everything. And then those guys will monetize what they have there for the benefit of their shareholders. Max Silver, here with George Paspalas. And Max Silver, as I said, to me, it's probably the best silver development story. The company is on the very fast track to production. They will be in commercial production in 2018. They expect something around the 10 million ounces they want to produce per annum. And honestly, I think there's no project like this I've seen in the world with 923 grams of silver equivalent per ton rock. Yeah, those are the highest grades in the world. And the company is $140 million in cash. They have no debt. That's also not common when you go into production. And they have a joint venture with Fresnillo, where Fresnillo has a 56% share and MEC has 44%. And Fresnillo is also the operator. And as George just told me this afternoon in the interview, Fresnillo already developed 3 mines in the Fresnillo trend, I mean in your neighborhood. So they really know what they do. They are fantastic mine builders. And we will hear in a second what's going on then. So maybe one thing on that. When they go into production, that's very uncommon. Normally, when companies go in production, what happens? They have to pay back, they have to pay interest, they have a bank in their neck, they have an off-taker in their neck, they're always under pressure. This company not. They can make money from the first day, and that's a big advantage, honestly. Also with costs below $7 per silver ounce in the production, I think it's outstanding. Our fourth partner here in the panel, Brian Mayer from PPX Mining. The company is, of course, Canadian-based. It's also a little bit of a unique model. It's exploration and exploitation in Peru. They work the Igor project in northern Peru in the La Libertad department, and they have so far in the Calanquitas, I hope I said that right, structure is approximately 448,000 ounces of gold and 16.6 million ounces silver discovered so far. Altogether, it's 730,000 ounces gold equivalent. And what I also like here is the company has enough money in the bank. They already started 1 week ago with the digging inside the mine, meaning they do some block sampling, they have a pilot plant running, and that means they start to generate really they start to generate cash flow. So that's important. They generate money and bring down the risk of the company. So now we want to talk a little bit about your 4 terrific companies. And as far as I know, Patrick, we are doing a little bit of Q&A afterwards, right? So if you have some questions, please feel free afterwards to post them. Patrick will go round with a microphone, I think, yeah? Let's start with Alexandria. Eric, as far as we said, you have those great partners in your company. You do a lot. How does your shareholder base work and help you? Like when you, for example, you sold the Zone West gold, the gold copper property to Agnico for the $5 million and the 2% NSR. How did that work out?
Well, the shareholder base for Alexandria Minerals is a very actually supportive shareholder base. They've been long-term shareholders. The ones that are the biggest shareholders in our company have been around for several years now. For instance, Agnico took their first 10% stake in Alexandria Minerals in 2010, and they've pretty much maintained that level in all our financing since then. We've maintained a good, strong relationship with all those larger, especially the larger shareholders. That, of course, with Agnico in particular, we meet fairly regularly because, as it turns out, our exploration offices in Val d'Or, Quebec, are right across the street from their Goldex facility. Their headquarters in Toronto is right down the street from ours. By coincidence, it's not far. So we maintain fairly good connections. And that, of course, when we discovered the West Zone, it resulted in their being involved knowledgeably fairly early on. We discovered that with 10 drill holes in a matter of a couple of months. It didn't take very long to get it from there to a resource level and to see Agnico pawing around because they needed feed for their mill, which is one of the reasons why we set up in a place like Val d'Or in the first place. Not only can you find, as an explorationist, large gold deposits, but you can capitalize a little bit on the smaller finds by making access with some of the unused milling facilities in the area.
Absolutely, great. Thanks. Patrick, what is a mineral bank like First Mining? I mean, give us an explanation on that, please.
Yeah, it's a different business model, and so many companies are focused on putting assets into production, but what we were seeing, in 2000, for the period of 2011 until earlier this year, that we're seeing historically low valuations. Like I'm a geologist and I'm a former mining analyst. I've been doing this for over 20 years, and Myself and Keith had never seen valuations this low. So the business model is simply to take advantage of these, incredibly low valuations and just start pulling the trigger and buy high quality assets. Let me put it this way. This market was so broken that it was cheaper for me to buy ounces than to drill for ounces. And so I think it was a once in a 20-year opportunity to go out and buy high quality companies or high quality assets that were under severe financial duress. We were buying assets for less than $10 an ounce. So we went out, we started from 0 ounces in the ground when we started this company in April of 2015. We've made 8 acquisitions out of 12 assets. We increased our asset base from 0 ounces in the ground to 10 million ounces. And that does not include our Goldland asset, which has 3 million ounces. Going forward, we're not going to put these assets into production. I'm not an engineer, I'm a geologist. Geologists are horrible at putting assets into production. I'm not interested in that. What we do want to do is, we're kind of in a transition point right now. We're going to put some money back into the ground. We're going to do some drilling. We're going to de-risk these assets. We're going to move them forward. But ultimately, the goal is to partner up with other groups, other companies, private equity groups, other management teams. They take the asset, they put it into production, and we hold on to residual interest. So, ultimately, the business model will be some sort of structure similar to a Royal Gold or a Franco-Nevada, except we're coming in the bottom up where we're accumulating, we were backing up the truck and accumulating high quality assets.
Mm-hmm. Thank you. George. A good friend of mine is one of your founding shareholders, actually, and he still has his stock, and he's totally happy, of course. Your stock performed so well in 2014 and 2015, and most of the other stocks were really declining, and you were up. I mean, you delivered, of course. Why was it?
I think we were one of the rare high-grade stocks that at $10 an ounce, we just don't keep the lights on. We've got a 15% after-tax IRR. And I think as people were moving out of the stocks that Patrick's talking about and their share prices are plummeting, we went into strong hands. Lots of big institutions came into us in the course of the last 2014, 2015. We became a very strong defensive play. So year on year, our share price in 2014 and 2015 went up. And I remember in 2015, we'd gone up a little and we were holding steady, go to the Denver Gold Show, and all these shareholders come in and everyone's getting beaten up by their shareholders, and they came in slapping our back and, well done, guys, well done. I said, well, we're just flat, you know. He says, well, flat's the new up. And it was sort of, a testament to the quality of the asset where people came in. And by virtue of having an increasing share price, during those times when the capital markets were shut, we actually funded the company. We, during the course of 2014 and 2015 and 2016, we raised $141 million US, both off 52 weeks high in a very depressed market. Again, it talks to the quality of the asset and management, of course. Talks to the quality of the asset. And so people who bought in saw a company get fully funded, also share price appreciation. And so we're really positioned to go forward now. And so we've enjoyed the uptick this year as well, not as much as a lot of other companies, but we never went down. Yeah. And so for a lot of our shareholders, they're pretty happy with the performance of the company.
Oh, yes.
Then we threw a couple of discoveries on the back of it, which helps as well.
Mm-hmm. That's right. Ryan, I see you have achieved a lot of significant milestones, corporate milestones lately. And what milestones can we expect for 2017?
Well, the last few weeks have been particularly important for the company because, as we had been telling investors, our goal for this year was to get our, quote, test mining and bulk sampling program up and running. And we broke ground on the mine just last week and already have completed several hundred meters of drifting in on the Kayinquita structure. And this was a very important milestone because, as was just mentioned, it can be very challenging for a junior company to go into production. And I'm a geologist as well. I had the fortune or misfortune to run an underground gold mine for a number of years and know all the pitfalls. And so one thing that we did was leverage the expertise of our partners in the project expert Peruvian underground miners who had the engineers, the workers, the permitting knowledge to enable us to get to this stage relatively quickly. And for our shareholders, we essentially took a lot of the risk out of the equation by leveraging this expertise. Now that the project is up and going, our next goal is to be at 150 tons of bulk sampling by January and February. We'll be shipping that material to a nearby toll mill, gaining knowledge about our resource. We'll be able to verify the resource estimate that was done by drilling with actual numbers of processing material. We'll be able to use the actual costs of mining, driving the ramps, raising, stoping, etc., to build a pre-feasibility study that very accurately captures the real economic potential of the project. That will be the next benchmark, a PFS, which outlines exactly what the project can look like, what the potential to grow the project and expand production. Simultaneous with this, we are also beginning to explore again. Our project, for those of you who don't know, is located in the northern Peru copper gold belt, a tremendously prolific gold trend with over 100 million ounces of production and reserves. We haven't had the chance to drill a hole in over 3 years. We want to get back to that. We've only drilled a 700-meter strike length of our main structure, and there's over 7 kilometers of structure yet to be tested. If we're exploring and developing at the same time, I think we're providing 2 great catalysts into the marketplace to help support our company.
Yeah, absolutely. Eric, I saw in your presentation that you have very low discovery costs. And I saw all up costs were $16, and particularly at the West Zone, you had 69 cents per ounce. How do you do that?
I don't know. It just happens. We're from our inception, we went public. Alexandria went public in 2006. So for the last 10 years, and 5 of the last 10 years have been pretty dismal markets. We've been fairly slow and steady in the exploration end of things, and so we've routinely spent, prior to the downturn, probably $4 or $5 million a year on exploration. Fairly thoughtful and steady as you go exploration. And I think that allowed us a little bit of time to contemplate what we were doing very seriously. We do love drilling. I mean, we like to drill. We like to spend money on drilling. That's the best. I'm a geologist as well.
And drilling costs are super cheap right now.
Now they're very cheap. That's correct. And so we've managed to do that in a fairly efficient manner. And that's all up cost. $16 an ounce includes paying for things like this. So we're fairly efficient about what we do, and we like doing that stuff. The West Zone was kind of a stupid number. I mean, it was 10 drill holes. We did a logical step out after building up resources on our Casaba project, and followed the trend under overburden, under glacial overburden. We just decided to do 200-meter step outs, and we hit on it in 2 drill holes and 8 drill holes after that. We had proven up an inferred resource on that. Mm-hmm. So it didn't cost anything before Agnico decided this would fit into their milling facilities there. So it was a good plan. I'd like to say it was a plan, but a lot of luck in exploration, and you take them when you can get them.
Great. Patrick, as said, you have elaborated the mineral bank model. Yeah. So let's dive a bit more into detail. What is the process in identifying and buying an asset? I mean, you have 25 projects. That's really a lot. Do you have a super large team? Do you have scouts in the world? How do you do that?
Yeah, that's a great question, because when we put this thing together, we already had a list of 80 assets, and we have a very strong technical team. Most importantly, our VP of Technical Services, a gentleman named Bill Tanaka, who's based in Denver. His specialty is doing resource estimates. So, I'll either hear about a story from a banker, or I get a lot of shareholders call me up going, you know what, these guys have been running this company for 10 years. They've diluted the heck out of us. They're not doing anything. We're frustrated. We want you guys to come in. So I get shareholders, bankers, people, or just contacts in industry. So, first thing we'll do is, if we see something that's interesting, we'll obviously go through the public disclosure, go through the 43101s, go through all the websites, what have you. If it still looks interesting, we'll contact the company and we'll sign a confidentiality agreement. The first thing I do when we sign a confidentiality agreement is I go after the drill hole database and the resource estimate. I'll be honest with you, I don't trust 43101s. I think most of them are garbage. I think a lot of companies game them. No, nobody here, though, of course. But so that being said, we will rebuild the resource estimate. And not only that, we use $1,200 gold. We're not using $2,000 gold or $5,000 gold or whatever. We use $12,000 gold, $1,200 gold, and we redo the resource estimate from scratch. If it's open pit, we pit constrain it. If it's underground, we use reasonable mining costs, and we try to determine whether the resource holds together. So it's funny. People are amazed how quickly we do these deals, but on average, in terms of due diligence, it takes months. We visit the site, we go through all the metallurgy, the resource estimate, we make sure that there's infrastructure. There's a lot of work in the background when we do these deals. And if a project looks intriguing, then we go hard and try to get a good deal. And that's the general process when we're working on these arrangements.
Mm-hmm. Okay. George, you're really on the fast way into production, of course, and your development, is working tremendously so far. And I think you have the ramp decline is 3,500 meters. How much is now done?
Yeah, 3,300 of that. Yeah.
So when do you think you're ready with the 3,500? Christmas? Nice little present for us?
Probably before.
Oh, good.
Yeah.
Lovely.
And I'm not a geologist. So,
Too bad.
That's probably a good thing.
And not prone to forward-looking statements.
But we found a wonderful asset. The geologist in the company, who a lot of you people here know, Peter McGaw, turned the tables on the most prolific district in the world for silver now, the Fresnillo Trend. And 1 of every 10 ounces of silver on the planet comes from this small area in Mexico. And Fresnillo, who are the operators in this area, Fresnillo Trend, for the last 130 years, they've been mining silver there for 500. They had this ground. They actually drilled the ground. They didn't find anything. They gave it up. Peter came in with a different geological theory, and hole 1 was a discovery hole. And it's just a fantastic story. And it continues to give today, and I hope you're going to ask me that question later on.
Definitely.
But what we do have, while I'm going down this long road to tell you about the ramp, is after our second discovery on hole 15, 2005, markets were closed, MAG couldn't raise any money. We offered a earn-in to Fresnillo to come in the operatorship. And that really goes to making MAG we're all special companies, but this particular asset is unique in the world. There's no doubt about that. You can look at our corporate presentation on site and look at the head grade of everyone else. It's double everyone else, but it's being built by Fresnillo, who are the best people on the planet to build this. And it goes to what you said, and you said about, it's a different DNA. I couldn't find an ounce of silver if it hit me on the back of the head. These people can, geologists can, but it's a challenge for them to build a mine. And the guy just walking in the door used to cover me when I was working for an exploration company building a mine for them in Argentina. It's a DNA shift. It's very difficult. We're so fortunate to have Fresnillo, who have built 2 mines on the same vein that we found, build this mine for us. And so that ramp is going in at, for you people in Quebec, it costs you about $4,000 to $5,000 a metre to put in a 5x5 ramp. They're doing this thing with a concrete floor, if you ever see the picture going around here again, for $1,500 a metre. They're doing single heading advance rates of 200 metres a month. They're just top-class operators. So we're going to get there very soon. We're going to get to the vein. Peter can finally go down after 10 years and kiss that vein. And the big fella will probably have a tear in his eye when he does that. And the accountants will get the cash flow component ready in the spreadsheets, because that's coming.
Mm-hmm. That's right, absolutely.
So they're doing a good job, and the ramp is really flying down there.
Mm-hmm. Yeah, I've seen some very nice pictures. Mm-hmm. Ooh, that looks really fantastic.
And not expensive, not overcapitalized.
That's the next thing, yeah. No, it's really working, definitely. Brian, Many junior exploration companies attempt a risky transition, of course, from an explorer to a miner. How do you intend to mitigate and reduce this risk? And also, for me, interesting, what differentiates you from developers and explorers?
Well, it gets to kind of this theme that's come out of this discussion in that as junior explorers, we have success geologically, we drill out these resources, and then the question mark becomes, okay, what do we do next? And that is almost entirely driven by economic considerations. The quality of the resource in terms of grades and tons, the potential cost of extraction, metallurgy, and then very, very importantly, the marketplace. I mean, it's wonderful to come up with these so-called dream sheets that have these project economics and have these capital requirements measured in the hundreds and hundreds of millions of dollars. But if the market's not available even for a $25 or $30 million development, then you've got to go back to the drawing board and go, okay, how do we go forward? And as I mentioned, we were fortunate enough to be introduced to a couple of very good partners in Peru with literally decades of experience, both in mining as well as in mineral processing. And even during the very difficult times of 2014 and 2015, when the equity capital markets just weren't available, we were able to partner with these groups, introduce them to our project, have them do their due diligence, and by doing simple equity for capital investment swaps, bring in the expertise that we did not have. At the same time, having these companies take on the project was a way of validating exactly what our concept was. They're certainly not going to take the risk just for shares in our companies if they did not believe that the deposit was ready to mine and was going to be profitable. So in a way, it validated our business model. So that's one way we've done that. And I think that's what does differentiate our company. As we look forward to 2017, as I mentioned, targeting 150 tons a day by January and February, up to 350 tons per day by the end of the year. This will be high grade underground with head grades of over 8 grams per ton gold. We see this as, fundamentally a transitionary phase, but this does separate us. We have no additional capital requirements to build the mine. The processing facility is paid for. In other words, we can step back as a group and keep concentrating on what got us here, the exploration, while using the expertise of our partners to build the mine, to build the processing plant, and bring us to cash flow. In other words, a sustainable business enterprise, which is words you don't usually hear in the junior mining space. But I think if there's anything we've all learned in the last 3 or 4 years, if you don't have that backdrop of solid cash flow, we don't know. If gold's down to $1,000, we still want to be in business. If gold's at $1,700, then fantastic.
Absolutely. Eric, what are the next catalysts and target achievements for 2017? What do you want to do?
Well, we're just, as you noted earlier, we're just wrapping up a drill program on our Oronata project. I won't go into the details of that right now, but the next steps are to ramp up drilling throughout the coming 12 months. Our goal by the end of the year, the next 12 months or so, is to upgrade the resource at our Oronata deposit. And to do that, we have a fair bit of drilling to do, both infill drilling as well as step-out drilling, because we're remodeling the whole project in order to bring in a recent development and identification of the potential importance of high-grade veins into what was formerly looked at as a disseminated gold deposit. So our real goal is at the end of the year is to reintroduce or submit 43-101 compliant resource estimate as dastardly as they can be. They're still kind of the basis from which we all have to operate. And in order to get there, there's going to be a lot of drilling. So a lot of the news flow coming out will be hopefully drilling, and we'd like to ramp up the drilling beyond what we've been doing this past few months.
And you have the money to do that, right?
We do have the money to do that at this stage of the game.
Important.
That's correct. Yeah. So that's a principal goal.
Patrick, what is the short-term strategy?
That's a great question. We always said when we were putting this company together that we were going to buy ounces, not drill ounces, and until the last 6 months, the market wasn't giving any credit for drilling. Matter of fact, if you drilled and came out with really good results, it would trigger a liquidity event, and everybody who wanted to get out of your stock would jump in and start selling. At the end of the day, you'd be down like 5%. I'm sure you gentlemen can attest to that. I think we've seen a major change in market sentiment. Obviously, things have cooled off a little bit, but I think what we're seeing now is, for us, it's getting much harder to do deals. Valuations have gone up, liquidity's back, there's capital coming back into the market. So, we had a few other acquisitions we had lined up, and it's like, it's like fishing. The fish got away. These companies, obviously weren't under duress anymore. So that being said, we've got 36 million in cash. We're planning a 50,000 meter drilling campaign next year on a number of our assets. I think what we need to do is, again, proof of concept. People are asking us, shareholders are asking us, what kind of assets do you have? How are you going to unlock value? So, we're going to go back to putting money back into the ground. We're going to advance these assets. We're going to de-risk them and move them forward. So we'll drill, do PEAs, do resource estimates, metallurgy. I'm spending a lot of my time with First Nations as well, which is a critical issue in Canada. That's going very well. So I think now what we have to do is generate internal value, and that's what we're getting back from our shareholders and from the market.
Right. George, as we know, you guys, especially Peter, are very successful in drilling holes in the Earth's crust. And what you delivered so far is outstanding. But you did 4 holes last year, and then you did another 12-hole program in the Valdecanas vein, and you hit a lot. So to my understanding, I know you are not allowed to say that, but I'm allowed to say that. It looks like it's a mine below the mine.
Well, I didn't say that. Let's call it the first bit, which was discovered in 2003 and proven up over the following few years, is 12.5 million tonnes of about 250 million ounces of silver, 1 million ounces of gold, and about 6.5% base metals. We call that the Bonanza Zone, and I think I can say that's mine 1, because that's the mine that's being built now to come into production in 2018. And at the end of 2014, we thought, well, we better stick a few holes under this just to prove that that vein closes off like most of the other veins in this Fresnillo epithermal vein system. And so we stuck those 4 holes in early 2015, and we failed on that objective because it didn't close off. In fact, it went the other way. It got significantly wider, which is very important as you go deeper into a mine. Even the geologists know that. And but that's pretty important. But more interestingly, through 500 years of mining in this Fresnillo trend, there's very high silver grades at the top of these veins, which are like a barn door. Right? They're about 6 metres wide, 300 or 400 metres high. And what makes this part of Mexico so unique in the world, where you normally get these veins, they run 300 or 400 metres long. In Fresnillo, they run 3 or 4 or 6 or 8 kilometres long. And that's why that's got such a natural endowment. So we drilled underneath it, and it got wider. And we thought, okay, well, if it gets wider, it's probably full of base metals, which is typical. No. We got 27,500 grams per tonne of silver. Silver shouldn't be down there. We followed that up with a number of holes now. First 4 holes showed us nice widening from 6 metres wide to up to 30 metres wide. Good silver grades, very good gold grades, good lead, zinc, and for the first time ever, copper in the system. This last round of holes this year, which is the second program Jochen's referring to, was 12 holes, which really proved the widening. But it also showed that this thing now is going 800 metres long. It's open on both ends. It's probably going to go a distance of about 2 kilometres long, and that's a forward-looking statement. But MAG does have a history of turning forward-looking statements into fact. This is pretty exciting because here's the Bonanza Zone. That's a phenomenal project, yeah. Underneath that, we have something that's up to 5 times wider, maybe 30 to 40% longer. and it's going to get accessed from the capital we deploy to access the upper mine. So, yeah, we've done 2 drill programs. It's been remarkable. It's, and I'm sure, I shouldn't joke about geologists. Geologists what gets us here in this industry. They're the most important. Look, you know what? I know this is recorded, and everyone who knows who's going to kill
There's
me
no
for
engineers
saying
in the
this,
room.
but-
It's okay.
Oh, yeah, there's one over there. He's a metallurgist too, and he's also from Australia. Very important part of our business is exploration. It's the high risk, but if you don't have it, you don't have it. If you don't find it, you don't have anything to go on with. And we've had 4 remarkable discoveries on these 2 veins. And the challenge for us is we can't get away from this Valdecones vein. I tell you the story. When we came on the ground, drilled that hole, found it, drilled a few more holes, found the big vein, joint ventured with Fresnillo. Once we worked together for a while, they worked out how we found those 2 veins. Went back onto their property, they found 600 million ounces of silver. In some cases, going down the original drill collars where they drilled before and drilling 150 to 250 metres deeper. So we see all these veins that they've found coming to the joint venture ground. We haven't even touched that yet. So yeah, we've done these 2 drill programs, we keep finding stuff, but we really want to get out there into the grass roots of the joint venture ground and drill some of the really good targets we haven't touched yet.
That's right.
Thank God for the geologists, really.
Yeah, it's tough. Well, Brian, PPX is advancing with both exploration and exploitation, of course, like your test mining, as you said, you started already with bulk samplings, which is quite unusual for a junior. What message does this send to the investment community, and what do you receive from the investment community?
Well, first thing, I just want to make an observation here, and I think many in the room might have picked up on this. You look at the 4 companies that are presenting here, and there is a common denominator. All of us are active in districts which have tremendous mineral endowments. They are places of active mining operations that have been going on in some cases for hundreds of years. And it's almost, you know, a verification of the old adage, the best place to find a new mine is next to an old one. I mean, we've got the Abitibi, we've got the Fresnillo district, we're in the Northern Peru copper gold belt. These are 100+ million ounce gold, billion ounce silver districts. And I don't think it's just a coincidence we're all up here talking about what our companies are at different levels of development, but your story, you know, is a classic one. A little scratching of the head, geologists thinking about things a little differently, drilling some more holes. You know, you've been exploring in the heart of the Abitibi for a number of years, and then all of a sudden you figure things out, and you've taken advantage of projects that other people just, didn't want to take the extra step. That's kind of what we do as a group. You know, that's why the Barracks of the world, the Yamanas of the world pay attention to the things that we do, is because we're the ones out there drilling those holes. And so back to the question, it's what gets me excited is hearing these types of things. I mean, I'm looking, now from the perspective of PPX, we've drilled 18,000 meters, 70 drill holes on a 700-meter strike length of a structure and defined about 700,000 ounces. Great, that's wonderful. But then you step out along strike, then you drill a little bit deeper. You go to some other places, and geologists, we like to think we're really clever and we can pick that perfect hole the first time around. No, sometimes it takes a couple of years for different people to come in and get involved in the projects. And I think, for us, where we're headed is a company that may have, this is going to definitely be a forward-looking statement, 30 to 50,000 ounces of production per year by 2018, but if we can validate this multi-million ounce resource potential through the drill rig, then we start to replicate some of the other success stories that we've been talking about. And I think that's what really kind of sets us aside in our niche. And each one of us here tonight, I think it's interesting. We're all taking a little bit different approach, but I think in a very successful manner.
Mm-hmm. Absolutely, yeah, definitely. So last round for the questions. Eric, how important would you rate the location and the jurisdiction you are working in for your company's success?
I think it's probably important for many companies, not just Alexandria Minerals. In fact, as Robin was just commenting, and George before him, the location is, we're in these well-endowed areas. But to answer your question, obviously the right geology has to be there for finding the deposit as an explorationist. It's not only about geology, though. It is, we happen to be in a very stable political jurisdiction in Canada in general and Quebec in particular. While there are challenges to the mining industry all over the world as societies and cultures change, we are in a jurisdiction that is trying to figure out how to manage those challenges so that everybody can keep doing what we need to do while accommodating. It's very much an accommodative mechanism of managing these situations. So it's very important that we have a political system like that and allows us to be able to do the job we need to do while managing other people's and all stakeholders' expectations. So yes, it's quite important.
Yep. Patrick, what is the long-term strategy? Meaning, you just explained how you do it, what you want to do short-term, but what is the, let's say, also for your shareholders, the long-term strategy? Do you think that you can maybe dividend out properties or even companies, or do you say, maybe we have the chance with rising metal prices, we can bring 2, 3, 4, 5 into production, yeah, and then we can maybe pay dividends, things like that. What is the long-term approach?
Yeah, I mean, the long term, as I mentioned before, we're not going to put these assets into production, and the goal is, move them as far along as we can. So in terms of increasing resources, have more confidence in the resources, measure indicated, get them into pre-feasibility, feasibility studies, permitting, that sort of thing. But ultimately, we'd rather have another party. We'll let the engineers have it then, and assuming that you're putting it in good hands. But we want to partner up with good groups, good companies that are producers that know how to put assets into production. They'd move it forward, but the key thing is we would hold on to some sort of residual interest. So a royalty, a stream, a joint venture, a spin out, or some combination of the above. So ultimately, the business model would be, we'd be entirely, 5 to 10 years from now, we'd be an entirely different company where we're more like a Royal Gold or Franco-Nevada or even a private equity group where we have a collection of streams, royalties, joint ventures that are generating revenue and ultimately deliver a dividend to the company. Keith created this company. Keith would always say, I'm not, I've already created $2 billion companies. First Mining Finance is going to be my $3 billion company. And, Keith is not here to make $100,000. He's here to make millions of dollars. He's done this before. So, we have a vision. We're sticking to it. So far, it's gone remarkably well. And the next 5 to 10 years, First Mining Finance, I think, is going to really be have a significant presence in the capital markets.
Mm-hmm. Definitely, for sure. George, I always love when you do some forward-looking statements, so I urge you a little bit to do that also. How do you think is MEC positioned to benefit from rising metal prices concerning your production profile then? I mean, you want to start with around 10 million ounces per annum, which the silver market really needs, because we are already in a deficit. And we will need more and more silver due to more high-tech applications, of course, and solar industry. So where do you see MEC? I mean, do you want to buy more companies? Do you want to finally explore your project and not only stick with one vein?
Well, my first forward-looking statement is I'm going out to buy a pair of shoes like yours tomorrow.
They're cool, huh?
Because mine are pretty boring compared to yours. Having all-in sustaining cash costs of $6 an ounce gives you great torque to a rising metal price. And obviously when we come online, even at today's silver price of, say, $18 an ounce, we're making $85 million of after-tax free cash flow, which even if our new area of deeper mineralisation materialises at some point in time to be developed, that capital is incremental. Even if we could drill whatever we could on that joint venture ground, the cash is incremental. And as good as the asset is, at the end of the day, we're a one operating asset company. So, ultimately, we have another property in the state of Chihuahua where we've had 3 high-grade discoveries on that property as well. So ultimately, we want to get back on that ground, and we're slowly working towards that. It's a bit like watching paint dry, but ultimately we'll get there. It's only about surface access. We own the minerals for 50 years, renewable for another 50. So that would be the first port of call. Acquisitions, you have seen a lot of value destruction happen in our industry through acquisitions. I think these guys down the end have taken a very opportunistic part of the cycle to build a very good portfolio. A lot of you people know me from a previous company. I'm an operator, a mine operator, turnaround guy. I know what it takes to try and fix operating assets. We're not that company. We have 8 people in our company. We will probably look at investing our capital into further exploration on our properties, the joint venture ground and our Cinco de Mayo property. Acquiring operating assets for us is a stretch. We've got a plain vanilla story, very high grade, but it's a plain story, very easy to follow, very easy to understand the strategy. We won't be changing that too much. Right.
Last question, Brian. You have a very interesting story. It's small by now, but you do the right things and you will deliver, that's for sure. I'm pretty sure on that. But how do you want to get your story in front of the audience in the future? What measurements do you want to do to make PPX more known?
Well, I think the real key is establishing, these benchmarks or milestones and then making them really clear. I mean, it's especially common in the junior space to hear a lot of chatter about, yes, we're going to go drill a hole here, we want to do this there, and what have you. But when you lay out a program or a series of expectations for the investor and make it clear, like I said, we want to be at 150 tons a day by January, February. We want to ramp up to 350 tons per day by the end of the year. That's pretty clear cut. Either you get there or you don't. And it's like, when are you going to get that last 300 meters of ramp done? When you start establishing these benchmarks and then hitting them, people start to pay attention. And for a company like ours, which we are starting off at a modest level, but we see the pathway to a significant production horizon, it's important because you want the investment community to have the confidence that you recognize the significance of the benchmarks, and here's your plan to achieve them. As we head on into 2017 and start drilling again, part of that will be, okay, here's the logic of this drill program. It's not just to step out and wildcat, but we're going to incrementally grow our resource base. We have higher silver grades at depth that we'd like to investigate, 1,000-gram hits that need to be followed up on. But the logic is that this will help grow a resource base that can support future expansion of production. This is the type of thing that can help grow a company, and here's why. So I think the real key for keeping that message in front is to come to events like this, to expend the proper amount of money on marketing. I mean, the one thing that we've learned, and I'm sure everybody here on this discussion has learned, is to be frugal with your money. I'm the president and CEO. Kimberly Ann, who's with us, is the CFO and VP Corporate Development. That's it, guys. That's the executive group. We have 7 other full-time employees. We just added a mining engineer to oversee mine development this week. We're not going to go crazy and expand. We want to keep G&A low and grow in a careful manner so that when the shareholders and investors go, okay, they have X amount in the bank, they can see that that's going into the ground to help grow the value of the company, and it's not being spent in a superfluous manner. And I think when you put all that together, I think that's how you keep the message in front of everybody.
Absolutely. Yeah, thank you very much for that. So now time for some questions. Yes? Are there any questions in the audience? Please, Patrick, maybe you can go to Pascal.
Thank you, Patrick. I have a question for the other Patrick on the excellent business model. Why can't we find lots of copies of First Mining Finance in the market? Is it lack of knowledge, lack of money, or is it because potential competitors just don't have the guts to pick up assets in the downturn of a cycle?
That's a good question. I get that question a lot. And I think it's interesting when you meet these companies. When we meet these companies that we were acquiring, we weren't the only ones that were courting them. And it's funny. When we're working on these deals, usually I'm the one that gets the ball rolling, trying to negotiate with them. But ultimately, it's Keith Neumeyer and Keith's track record. So these companies, the management teams are fatigued, and but they also want to make sure that. If they're going to, hand over the reins, they want it in good hands. There were other groups trying to do what we were doing, and it wasn't easy. I mean, when we got I started with Keith in January 2015. It took us 3 months just to raise $5 million, and the environment was just awful. Like that was just when oil collapsed. There was no money out there. People hated mining. It was toxic. Everybody was getting killed. So. We barely raised the $5 million, and the reason we were able to do it was because of Keith. And then the second thing is, as I stated before, companies if they're going to walk away, they want to be sure that their company or their assets go into good hands. And and Keith is able to do that. I bring Keith into the room. He commands respect, and that makes things easier. But there were other groups trying to do what we're doing, and like I said, people are so critical to this industry, and there's not enough good people, and so you got someone like Keith Neumeyer who has a lot of credibility that opens up a lot of doors, and because of that, we're able to get things done.
Another question? You're all hungry, huh? and there's another one, Pascal.
This one is a question for everyone. It's about drilling costs in the different regions, let's say all in per meter. And how do you see the trend of those costs? And eventually what will be the implications for your particular business of that trend?
I'll start. Drilling costs have come down substantially, and my reference for this is Mexico. Also British Columbia, but I'll talk about Mexico. There's two overlays in Mexico on that. The first one is the general downtrend in metal prices. People just not having cash to deploy drilling. Contractors can't name their price anymore. Supply and demand, the price goes down. What makes Mexico a bit different, though, in January of 2014, the Mexican government levied a 7% NSR royalty on mining companies. You can plot precipitously how the investment in exploration in particular fell off the cliff in Mexico with that tax. And so what we're finding in Mexico, probably Arturo, you can back me up on this. Pre-2014, we're probably paying $125 to maybe $150 a metre. We drill about a kilometre long hole. Most of they're long holes. We're now paying in the order of 75. But we've changed out drillers, and we've sort of gone. There's another overlay in this. We've gone up the ladder of driller quality as well as the prices come down. So we've got like a double hit on the benefit of lower prices. You just get contractors are more aggressive to get your work now. So the people who are at $200 a metre are now bidding $80 a metre to get the job.
Another comment was on everybody.
Sure. Well, it's funny. As I mentioned, we're working on a budget to do a substantial drilling campaign at some of our assets, And I had one drilling company come in that said, you know, we can either do it at cost plus 10%, or even they would do it where they just give a fixed sum. So if we're telling them we're going to do, you know, 10,000 meters, they'll just do a fixed cost. And if they have any, you know, if they lose any holes or lose rods or anything, they eat it, not us. So it's amazing how competitive it's become. You know, I've got 6 or 7 bids on my desk, and you know, I'm seeing drilling costs well under $100. You know, anywhere from, you know, $60 to $80 a meter. So it's just incredible. And also, you know, not just the drilling costs, like mobilization costs to come down. You know, $60, $80 drilling, and the drillers, we don't have to pay to feed them and house them. They eat that as well. So I'm just absolutely blown away by what I'm seeing. There's lots of drilling companies out there. Yes, things have turned around, but they're not like they were 5 or 6 years ago. And it's an incredible opportunity. If you are able to get money, you can get a lot of bang for your buck with drilling.
Yeah, so Val d'Or, Quebec is a fairly unique place as an infrastructure-rich place. It's been has a long history of mining. People make their living in the mining industry. And it's a really good place to go to see the effects of upturns and downturns in the mining sector in general and the gold sector in particular. As already noted, and as you might guess, certainly drill prices right now are as low as I've seen them in a long time. Our direct costs are about $45 a meter. When you add up assay and geologist time, you're probably looking at something under $100 by the time you add all that in. That's down from $70 or $75 a meter 4 years ago, and $125 a meter all up costs. So it's improved, but the drilling industry has been busy. We're seeing already in the Val d'Or region a certain level of busyness. So I anticipate that to start changing fairly directly as time goes on here. Curiously, assay labs are quite busy. It's tough to get your samples analyzed in a reasonable amount of time, and probably that's because the gold mining companies, the bigger corporations, have been busy themselves all throughout this time period. They're making money. Canadian miners are making money because the price of ounce of gold in Canadian dollars is pretty robust these days, much more than in the US dollar case. Mm-hmm. So they keep drilling, looking for gold in and around their mine areas. So it's going to change, and yes, all costs are going to start rising here shortly as time goes on.
Brian, you want to add something from the Peru perspective?
Yeah, well, number one, I'm jealous of all these gentlemen drilling in the outskirts of Val d'Or in the streets of Fresnillo. That's a wonderful thing. Kimberly, my last company, Prodigy Gold, the project was in Ontario, and we had those good old $70 to $80 per meter costs, and that was wonderful. Drilling conditions are a little bit more challenging in the northern Peru copper belt due to the age of the rocks, the structure, blah, blah, blah. And also, uniquely, the downturn in exploration activity that most of the industry saw in the last 2 to 3 years did not really hit Peru particularly as hard. So there wasn't the big pullback in price. That being said, we just negotiated a contract for a drilling program that we're about to begin, and it's 25-30% lower than it was before, Kimberly. So, I mean, we're seeing the numbers come back, but still, direct drilling costs are in the $120 to $140 a meter range. But again, that's down from $180 to $200 a meter 3 or 4 years ago. Not quite as dramatic as in these other jurisdictions because the demand didn't really slack off to the extent it did elsewhere. But it has become much more competitive, and you know, we're just looking forward to getting a drill rig turn again, to be honest. That's what's produced all these results that everyone's so happy to report. And you've got to drill to make that progress.
Yeah, absolutely. So, Patrick, we are fine? Time-wise? Super. Then, thank you very much, Eric, Patrick, George, Brian. Thanks a lot. Yeah. And thanks to you also for your attention and good questions also. And please enjoy the main course, and we move on in approximately 20 to 25 minutes then with Paul Burton. Thank you very much, guys.
Thank you.
Thank you.
Well done.